Next question. ICL is proposing to take over SVL. So ICL is acquiring company and SVL is target company with an objective to diversify. ICL's profit after taxes has grown at the rate of 18% per annum and SVL's profit has grown at the rate of 15% per annum. Both the companies pay dividend regularly. Summarized P&L account of both the companies are as follows. Sales is given, operating income is given. Amount of interest is given, tax provision is given, and profit after taxes is given. Amount of dividend is given. Then we have been provided with the balance sheet information. Land and building, plant and machinery, furniture, current assets, current liabilities, creditors, overdraft, tax provision, proposed dividend, paid up share capital, reserves and surplus, borrowing, and capital employed. The question is providing market price of the share is 52 and 75. Next, ICL's land and building are stated at current prices. SVL's land and building are revalued, highlight the portion, 3 years ago. So it was revalued 3 years ago. There has been an increase of 30% per year in the value of the land and building. So since then, say there is an increase at the rate of 30%. SVL is expected to grow at the rate of 18% each year after the merger. So afterwards the growth rate is going to be say 18%. ICL's management wants to determine the premium on the shares over the current market price which can be paid on acquisition of SVL. You are required to determine the premium using one, net worth adjusted for the current value of the land and building plus estimated, highlight the portion, average profit after taxes for the next 5 years. Second, dividend growth formula. Third, ICL will push forward which method during the course of negotiation. Year 1 to year 5, information is provided for the future value interest factor and future value interest factor at 30% and 15%. I request all of you to go through the question, please. Let us have understanding of this question. This question is basically about the simple valuation. This question is talking about the merger. However, the question is not related to the merger. The question is simply of the valuation. The question is providing the information that say a company called ICL is proposing to take over a company called SVL. Like that information is given. The question is providing the information like detailed where too much information is given to us. The question is providing simply that the acquiring company's management wants to determine the premium on the shares over the current market price which can be paid for acquisition of the target company. We have been provided with the price of the target company 75. So what is the premium that say we can pay? That is a question. We are required to determine the premium using. So how to determine it? We have studied that say there are multiple methods of the valuation. From that say they have chosen 2 methods of the valuation. The first is given a name as the net worth adjusted for the current value of the land and building plus estimated. Average word is clearly indicating that so you have to ignore time value of money. Profit after taxes for the next 5 years. This is the way you are required to do the valuation. The second method by which you are going to do valuation is dividend growth model. So suppose I am just say taking examples. Suppose in the first case the price is 90, in the second case the price is 100. What is the current price? Current price is 75. So what is the premium? Premium is 15. What is the premium? Premium is 25. So we are required to make the computation of the premium like this: 15 upon 75 into 100, that comes to 20 percentage. 25 divided by 75 into 100, that comes to 33, 1/3 percentage. This is the way we are supposed to make the calculation of the premium using both the methods. This is what we are required to do. Okay. Now let us have understanding, let's say, how to make calculation of this 90 and 100. These are the assumed figures. I hope that you understand that much. Now proceeding further, let us understand carefully. Now friends, over here they have used the word net worth. First of all, we'll have a discussion before we proceed further. As far as the net worth is concerned, we can say that the net worth is 785 crore. So we have to start making the calculation of the answer using this 785 as the starting point. 1. The question says further, adjusted for current value of land and building. Language of the question speaks that acquiring companies' land and buildings stated are current prices. We are basically not concerned with the acquiring company information. We are concerned with the target company information. Dear students, all of you can very well understand that say all this information are of no use of the acquiring company. We just have to compute the premium over the current market price of the target company. So this information is of no use. This information is of no use. Okay, now I am reading the relevant portion. SVL's target company's land and building are revalued 3 years ago. Of course, whatever the current value which they are providing over here is the value before 3 years, that is 190 crore. The question says that there has been an increase at the rate of 30% per year in the value of the land and building. So I request all of you to use your calculator along with me. We understand that say in the first year it is 190 into 30%. So there is an increase of 57 crore. In the second year it is 247 into 30%. So the answer is 74.1 crore. In the third year it is 321.1 crore into 30%. That is 96.33 crore. So the total amount of the increase is 57 plus 74.1 plus 96.33. That comes to 227.43. So whatever the net worth 785 crore which we had discussed plus 227.43 crore, that is supposed to be added over here for the purpose of valuation. The question does not end over here. It says that plus, that is in addition to that, estimated profit after taxes for the next 5 years. We have been provided with the information about the target company data in which its profit after taxes is 250 crore, I'm sorry. The question is providing that the target company's growth rate will be 15% per annum. So we understand that over here we are required to make the calculation of the profit after taxes for the next 5 years, and then we are required to take average of the same. That is the way we are supposed to calculate the answer. So first year, second year, third year, fourth year and fifth year. Use a calculator. 250 into 1.15. You don't have to write anything. Then 250 into 1.15 raised to 2. That is 330.625. Next year it is 380.22. Next year it is 437.25. Next year it is 502.84. So it is 287.5 plus 330.63 plus 380.22 plus 430.25 plus 502.84. So the total is 1938.44. The same would be divided with 5 years. So it is 387.69 crore. That is the way we are required to compute the average. Or we understand that, say over here, whatever the ready-made information is given to us, using that also you can do answer. It is 250 into 7.7537 divided by 5. So use your calculator. 250 into 7.7537, that comes to 1938.425 divided by 5. That comes to 387.69. That is the way we can make the calculation. So friends, what will happen? So there are three things as I told you. One is the net worth, that is 785 crore. Second is the appreciation of the value of the land and building. Again, like smart students like you may have a working like this, that this 190 into 1.30 raised to 3. This is the current value of the land and building minus 190 directly. So you'll get the appreciation amount. So you can see that, so for the 30%, 3 years future value factor is 2.197. So what will happen? 190 into 2.197. So 417.43 minus 190. That comes to 227.43. That is also the way you can calculate the answer. This is the first method. Let us write first of all the answer for the first method, and then I'll discuss with you with the second method. So I request all of you to write down answer along with me. First point. In this question, we have to simply calculate price of equity share by two methods. Second point, we have to compute value of share using both the methods, and based on that premium is supposed to be calculated. Full stop. Heading right down. Method number 1. In that write down, net worth adjusted for current value of land and building and adding 5 years average PAT, that is profit after taxes. In the breakdown, working note number 1, calculation of number of equity shares. So it is equity share capital divided by face value of share. We have been provided with information that the paid up value of the equity share is rupees 125 crore and face value is rupees 10. So it is rupees 125 crore divided by face value of equity share is 10 rupees per share. So final answer will be 12.5 crore. So the number of equity shares are 12.5 crore. Working note number 2, calculation of increase in value of land and building. So in that we will have answer like this: current value minus value before 3 years, because question is providing that say there is an increase at the rate of 30% per year for 3 years. So it is an amount of 190 crore into 1.30 raised to 3 minus 190 crore. Dear students, as we know that we are required to use the factors which have been provided to us in the example. So over here we are going to use these factors: 2.197, minus 190 crore. So 417.43 crore minus 190 crore. So 227.43 crore. This is what we understand is the value of the land and building increase. Working note number 3, calculation of average profit after taxes of next 5 years. In that we have to work out the answer like this: total profit after taxes of 5 years divided by n. So in that it is 250 crore into 1 to 5 factors, that is 1 to 5. In that say the factor is 7.7537. divided by 5 years. So 250 into 7.7537. So 1938.425 divided by 5. So 387.69 crore. This is the average profit for the next 5 years. Working note number 4. Calculation of total value of SVL, that is based on this method. It is net worth plus increase in value of land and building plus average profit of next 5 years whole divided by, this is what the answer is. So net worth is already provided to us an example. It is an amount of 785 crore. That is what's the starting point of our answer. Plus increase in the value of the land and building 227.43 crore. Plus average profit for the next 5 years 387.69 crore. $785 plus 227.43 plus 387.69. So 1400.12 crore. This is what we understand is the total value. The same would be divided with the number of shares, and based on that will compute the price per share minus the current price, that will give premium per share. Right answer? Calculation of premium. So in that, price per share, it is 1400.12 crore divided by number of equity shares. Number of equity shares are 12.5 crore. So 1400.12 divided by 12.5, that comes to 112.01. Next is a premium per share. $112.01 minus 75. $37.01. We can compute the premium in percentage term also. That is 37.01 is the excess price over 75. That comes to 49.35%. This is the way the premium can be calculated using the first method. Now we have to do it similar working for the second method. So just revising the first method before we proceed for the second one. The first is simple working note for the number of shares. Second is the increase in the value of the land and building. I have dictated answer to you with a shortcut method. However, at the same time you can understand that say you can go with the long method for making calculation of answer. This is the long method, in which say you compute the individual appreciation for the first year, for second year and for third year. So this is the total appreciation. Next, afterwards we will have So the average profit after tax is for the next 5 years. So you compute the total PAT for the next 5 years. The total profit for the next 5 years is multiplication of this two value divided by 5 years. Or otherwise, we can understand again in detail like this. For the individual year, you compute the profit. First year, second year, third year, fourth year, fifth year. Then you compute the total. The same is divided by the number of years, 5. Based on that, say you compute the average. Then the total value is very simple. As per the literal information of the question, we have to go, in which it is the net worth, increase in the value of the land and building, and profit for the next 5 years. The total value divided with the number of shares will give the price per share that you are ready to pay as per the first method. In comparison to the current price, there is an excess price, and that is a premium. Accordingly, the premium in percentage term can be calculated.